Variance analysis is a control tool where we compare the actual results with the budgeted results. The differences are then analyzed by the management and we try to improve the performances. In the variance analysis concept, one thing that you should keep with yourself is whenever the word standard comes, it means per unit budgets. Standards are per unit budgets. If you will keep this thing in your mind, variance analysis concept will be very easy for you. The first variance we're studying here is direct material variance. The direct material flexible budget variance is a difference between the actual materials cost and the total standard material costs. A sample standard for direct material would look like this. It includes quantities of material, for example, 3 kgs are required per unit, and a cost per input of material, for example, $2 per kg. This gives you total cost required for production. 3 kgs times $2 per kg gives you $6 per unit. The standards, which are per unit budgets, will be then used to find out a flexible budget, and direct material flexible budget variance will be actual material expense minus the flexible budget material. For example, if I'm using 2 eggs in production of 1 bread and 2 eggs is my standard, then to produce 100 breads I need 200 eggs. To produce 200 breads I need 400 eggs. And if I'm setting up a standard price of 1 egg as $1, so to produce 100 breads I need $200 worth of eggs, and that's my budget. If actual expense for egg is different, that is further analyzed to see whether there is a price change or more eggs have been consumed. Attaining efficiency in buying and using materials require good control over both the price paid for the materials and the quantity for material used in productions. Now, since price and usage can move in opposite direction, we must analyze the total variance of material by breaking it down into its price and quantity components. First, we will be doing a material usage variance. Material usage variance or quantity variance analyze that how much material is used in the production against how much should have been used. The formula we're using here is actual quantity minus standard quantity times standard price. The same formula, AQ minus SQ times SP. I'm going to use the same mnemonics for further variances, so keep that in your mind. This will not be given in your exam, so you need to memorize it. The formula is simple. Actual quantities are matched against what should have been used, the standard quantities, and you multiply the standard budgeted rate of materials. SQ here is standard quantity of the resource that should have been used in the production, which will be taken by units of output of finished goods multiplied by standard resource input per unit of output. For example, how many kgs are required? Since standards are per units, we multiply them with the total output of units. For example, total production, to find out how much it should have been used. Actual quantities might be given in kgs or pounds or maybe units. Standard rate here is the standard cost per unit of material. A company isolates its raw material price variance in order to provide the earliest possible information to manager responsible for the variance. The budgeted amount of material usage for the year was computed as follows. 150,000 units of finished goods times 3 pounds per unit times $2 per pound gives you $900,000. Actual results are we produced 160,000 while budgeted was 150. Raw material purchased is 500,000 pounds. Raw material used are 490,000 pounds and cost per pound is 2.02. We need to first find raw material usage variance. So here AQ, actual quantity used in production, is 490,000. I'm taking used in production, not purchased. Standard quantity is standard allowed for actual output. So 3 pounds multiplied by actual production 160,000. This is a flexible budget figure giving you 480,000. Standard price here is 2 pounds, $2 per pound. And so putting that into this formula, you are getting 20,000 unfavorable variance. Second variance here is direct material price variance. The price variance is matching the actual price against the budgeted and multiplying it with the actual material used. So formula is AP minus SP times AQ. Remember that formula because I'm going to use the similar mnemonic for further variances. AQ is the actual quantity used in production and actual quantity of raw materials. Make sure you're picking up actual quantities of raw material. Students usually get confused between actual quantity of finished goods and actual quantity of raw material. Here in the variances, we are taking actual quantities of raw material used in production, and AP is actual cost per unit of raw material. SP is the budgeted or the standard cost of units of raw material. Now, sometime examiner will ask you for direct material purchase price variance. In that case, purchase price variance takes actual quantity purchased. If the question will ask you simply for direct material price variance, you will use the actual quantity used in the similar formula. Let's do a question to calculate price variance and purchase price variance. The similar data I'm using, now I need to calculate in this data price variance. Actual price is 2.02 which is given. Standard price is $2 per pound which is given. Actual quantity is used in production when we were calculating raw material price variance. Putting that in the formula, it gives us an answer which is 9,800 unfavorable. If in the same example I need to calculate purchase price variance, then I'm using AQ as total quantity purchased, and so the answer will be different. It will be 10,000 unfavorable.